Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Agricultural Loans and Mortgages Guide UK, Essential Insights for Farmers. Agricultural loans and mortgages are essential financial tools for farmers and rural businesses in the UK. These specialized lending options help individuals and businesses purchase land, invest in necessary equipment, or provide working capital for their agricultural ventures. Tailored to the unique needs of the industry, they differ from traditional commercial loans in their terms, conditions, and requirements. Understanding agricultural loans and mortgages. Defining agricultural loans. Agricultural loans are financial products designed to support your agricultural business needs. They can be used for various purposes such as purchasing new equipment, livestock, or improving your farm's infrastructure. These loans are tailored specifically to suit the requirements and financial cycles of the agricultural industry. Because of their customized nature, agricultural loans often have different terms than other types of loans, so it's essential to understand their specific details and conditions. Defining agricultural mortgages. An agricultural mortgage is a type of long-term loan used to purchase rural real estate or release equity from your farm property. They differ from standard commercial mortgages in that they are explicitly designed to fit the unique economics of the agricultural industry. Agricultural mortgages are typically taken out for larger amounts, with borrowing often starting at £25,000 and various available terms ranging from just 1 year to 30 years. Agricultural loans versus commercial mortgages. While both agricultural loans and agricultural mortgages can be used for your rural business needs, they differ in some essential aspects. Agricultural loans are usually short to medium-term loans aimed at specific farming activities, expansions, or improvements. They may be unsecured or secured, and they generally have flexible repayment structures to suit your agricultural income cycle. On the other hand, agricultural mortgages are longer-term loans secured by your farm property or land. These are used primarily to purchase or refinance agricultural property and may have fixed or variable interest rates. Compared to standard commercial mortgages, they take into account the unique characteristics and cash flow issues often faced by those involved in agriculture. To choose the best financing option for your rural business, you should carefully consider your specific needs and objectives. Assessing factors such as the purpose of the loan, the desired term, and the available security are crucial in making an informed decision. Whether you opt for an agricultural loan or an agricultural mortgage, understanding the unique aspects of each financial product is key to ensuring you achieve your business goals, while securing favorable borrowing terms. Benefits and challenges of agricultural loans and mortgages. Financial advantages. Agricultural loans and mortgages can offer you a variety of financial benefits. By opting for this type of loan, you can access competitive interest rates tailored to your agricultural business, making it easier to manage your finances. Depending on the lender, you can choose mortgage terms ranging from as little as 1 year up to 30 years, providing flexibility in your repayment schedule. In addition to this, agricultural mortgages allow you to borrow substantial amounts, over £25,000, for various purposes, such as purchasing land, buildings, or equipment, or even to release equity from your existing farm property. This can help you expand and develop your business, boosting your income potential in the long run. Potential difficulties. Despite the advantages, there are some challenges and difficulties you might face when applying for agricultural loans and mortgages. One of the major concerns is the potential for high fees and charges often associated with commercial mortgages. These costs can eat into your overall borrowing, so it's essential to carefully examine all the terms and conditions before committing. Interest rate fluctuations can be another issue. While a low interest rate may initially make the loan more affordable, any increase in the interest rate can put a strain on your finances and make it more challenging to keep up with repayments. To counteract this, consider discussing fixed-rate options with your lender and potential repayment structures to suit your cash flow. Finally, securing an agricultural loan or mortgage may not be an easy task, as lenders often require extensive financial and operational information to assess your business's viability. Additionally, lenders may impose certain restrictions or conditions on the use of the borrowed funds. In such cases, it's crucial to work closely with your financial institution and explore all the available options to make an informed decision for your agricultural business. Applying for agricultural loans and mortgages. The application process. When applying for an agricultural loan or mortgage, it is important to have a clear understanding of the process. Firstly, research various lenders that offer agricultural financing and select one that suits your needs. Prepare a detailed business plan showcasing your farm's potential, and gather essential documentation like bank statements and credit reports. Remember, a positive credit history improves your chances of approval. Next, submit your application along with the necessary documents to your chosen lender. They will assess your financial stability, and if they find it satisfactory, proceed with a property valuation. This is to ensure that the property meets the lender's requirements. Once all the steps are completed and approved, the lender will provide you with a loan agreement to sign, finalizing your agricultural mortgage. Agricultural tie requirements. An essential aspect of agricultural loans and mortgages is the agricultural tie, which ensures that the property is used for agricultural purposes only. An agricultural tie is a legal restriction placed on the property, limiting occupation to those who are employed in agriculture or their dependents. This tie is essential and non-negotiable for the lender, as it safeguards their investment and guarantees that the land will be used productively. In case the property needs to be sold in the future or if you wish to let it, be aware that the presence of an agricultural tie may decrease the number of potential buyers or tenants, as it narrows the pool of eligible occupants. Determining eligibility. Your eligibility for an agricultural loan or mortgage depends on various factors. Primarily, the lender will consider your credit history, business plan, and income capabilities. Additionally, they might require at least 2 years of farming experience to ensure that you possess the necessary expertise to manage the property effectively. Here are a few factors lenders assess to determine your eligibility. Credit history and score. Existing debt and financial commitments. Bank statements proving your income stability. The viability of your farming business plan. Relevant farming experience and qualifications. Ultimately, it is crucial to have a strong application showcasing your farming know-how, financial stability, and commitment to the land's productive use. By understanding the application process, agricultural tie requirements, and eligibility criteria, you can improve your chances of securing an agricultural loan or mortgage in the UK. Choosing the right lender. When looking for an agricultural loan or mortgage, it is crucial to choose the right lender to fit your specific needs. There are 2 main types of lenders in the UK that offer agricultural loans and mortgages: high street banks and specialist lenders. High street banks. High street banks are well-known financial institutions that offer a wide range of financial products and services. They might be a good option if you already have an existing relationship with one of them and if your financial situation is straightforward. Some high street banks provide agricultural loans and mortgages, but their criteria and available products may not be as tailored to the farming industry as those offered by specialist lenders. One advantage of using a high street bank is their familiarity with the general mortgage application process, and potentially lower interest rates. However, they may have a less solid understanding of the unique economics of the agricultural industry, which could impact their ability to find a suitable product for your needs. Specialist lenders. On the other hand, specialist lenders focus specifically on providing loans and mortgages for agriculture and rural properties. They have in-depth knowledge of the sector, which means they are more likely to understand your unique financial situation and requirements. Specialist lenders may offer a higher degree of flexibility when it comes to underwriting and can often provide tailored solutions to fit the specific needs of your farming business. They also have a better understanding of agricultural property valuations, and can take into account factors that high street banks may overlook, such as land quality, farm diversification, or environmental issues. However, specialist lenders may charge higher interest rates and fees compared to high street banks, as they take on more risk by lending to businesses with a unique set of requirements. Ultimately, it is essential to spend time researching and comparing both high street banks and specialist lenders to find the best agricultural loan or mortgage that suits your specific circumstances. Take the time to speak with multiple lenders, evaluate their offerings, and understand their eligibility criteria before making a decision. This will ensure that you secure the best possible financing option to support your farming business's growth and success. Loan and mortgage terms. Understanding interest rates. Interest rates play a significant role in agricultural loans and mortgages. These rates determine the amount of interest you'll be required to pay on your loan. Typically, interest rates on agricultural mortgages are tailored to suit the unique economic landscape of the agricultural industry. They can be fixed or variable and are determined by factors such as your financial situation, the size of the loan, and the lender's assessment of risk. It's crucial to understand how interest rates will affect your repayments and overall cost of borrowing. Make sure to compare various lenders and take advantage of tools like loan and mortgage calculators to estimate your potential interest payments. Loan-to-value ratio. The loan-to-value (LTV) ratio is an essential factor lenders consider when assessing your eligibility for an agricultural mortgage. This ratio represents the amount you're borrowing in relation to the value of the property or land you intend to purchase. For example, if you wish to buy a farm worth £500,000 and need a loan of £400,000, the LTV ratio would be 80%. Lenders may have specific LTV requirements for agricultural mortgages, so it's essential to know your desired LTV and discuss this with potential lenders. Generally, a lower LTV is considered less risky for lenders, which may result in more favorable interest rates and loan terms. Repayment methods. Agricultural mortgages can be repaid using two primary methods, interest-only and capital repayment. It's crucial to understand the differences and determine which one suits your financial situation and business needs. Interest-only. With an interest-only mortgage, your monthly payments only cover the interest charges on the loan. You're not required to repay the borrowed amount, capital, during the mortgage term. This option usually results in lower monthly repayments. However, you must have a plan to repay the outstanding capital at the end of the term. Capital repayment. In a capital repayment mortgage, your monthly payments include both interest charges and a portion of the borrowed capital. By the end of the mortgage term, assuming all payments have been made, you will have repaid the entire loan amount. Agricultural mortgage terms can range from as little as 1 year to 30 years, depending on the lender. Consider your financial capabilities and long-term business plans when deciding on a suitable repayment method and mortgage term. Managing your loans and mortgages. Diversification and sustainability. Diversification is an essential aspect to consider in managing your agricultural loans and mortgages. By expanding your farm's products and services, you can increase revenue streams and reduce the impact of market fluctuations. To achieve sustainable growth in your venture, consider adopting environmentally friendly practices and investing in renewable energy sources. This will not only help protect the environment, but also improve your chances of securing favorable loan terms from lenders who value sustainable practices. Refinancing options. Refinancing your agricultural mortgage can help improve your financial situation by securing a more competitive interest rate, or extending the repayment term. This can help lower your monthly payments and give you more flexibility in managing your cash flow. To explore refinancing options, reach out to various lenders and compare their offerings. Keep in mind that refinancing may come with fees and charges, so ensure that the potential savings outweigh these costs before making a decision. Equity release. Equity release is an option for those looking to free up capital tied up in their property. By taking out an agricultural mortgage, you can borrow against the value of your land or premises. This can provide funds to support your farming activities or invest in new projects that can contribute to the growth of your business. Before opting for equity release, it's essential to understand the implications of increasing your debt levels and the potential impact on your long-term financial health. By considering diversification and sustainability, exploring refinancing options, and understanding the benefits and drawbacks of equity release, you can effectively manage your agricultural loans and mortgages to support your farm's success and long-term growth. Conclusion. Taking out an agricultural mortgage can be a great way to support your agricultural business, whether you're looking to purchase land, expand your operations, or release equity from existing farm assets. By understanding the different types of agricultural loans and mortgages available to you, you can make an informed decision on the best option for your needs. As you explore your options, consider your long-term goals and what you want to achieve with your agricultural business. With the right financing solution, such as farm mortgages and loans tailored for agricultural land, you can access the funds needed to grow and thrive within the rural sector. In addition, make sure you research lenders and compare their offers to secure a mortgage that suits your financial situation and goals. Consider not only interest rates, but also the terms and conditions associated with each agricultural mortgage. By doing so, you'll be better positioned to make a well-informed decision when it comes to selecting a suitable loan option for your farm or rural business. Finally, remember that seeking advice from professionals, such as mortgage advisors, can be invaluable in helping you navigate the complexities of agricultural mortgages. Their expert guidance can further steer you towards the right financing solutions that support your agricultural business effectively. What is the process of obtaining an agricultural mortgage in the UK? Obtaining an agricultural mortgage in the UK typically involves a few steps: assessing your eligibility, gathering required documentation, selecting a suitable lender, submitting an application, and awaiting approval. Keep in mind that agricultural mortgages are often tailored to the unique circumstances of each applicant, so the process can vary depending on individual circumstances and requirements. Which lenders offer agricultural mortgages and loans? Several lenders in the UK offer agricultural mortgages and loans. It's important to research your options and choose a lender that understands the specific needs of the agricultural industry. You can find more information on specialist lenders. We can help you to find the most suitable lender for your needs. Are there any specific requirements for obtaining an agricultural mortgage? Yes, there are some specific requirements for obtaining an agricultural mortgage in the UK. These can include sufficient income to cover the repayments, a reasonable level of experience in the agricultural sector, and the appropriate planning permissions for the property. Additionally, lenders may require a detailed business plan outlining your objectives and demonstrating financial viability. For a more comprehensive overview of eligibility criteria, contact us. How do interest rates differ between agricultural and residential mortgages? Interest rates for agricultural mortgages can be higher than those for residential mortgages, due to the specialized nature of the agricultural industry and the risks involved in farming. The interest rates for agricultural loans will vary depending on the lender, your financial situation, and the specific terms of the loan. It's essential to do thorough research or consult with a financial advisor to determine the best mortgage option for your needs. Can I purchase a farm with an agricultural tie? An agricultural tie, also known as an agricultural occupancy condition, restricts the occupancy of a property to those who are employed or have been recently employed in agriculture or forestry. If you meet these conditions, it is possible to purchase a farm with an agricultural tie, but it may be more challenging to secure a mortgage due to the restricted resale market. For more information on mortgages for properties with agricultural ties, please contact us to discuss further. What are the repayment options for agricultural loans and mortgages? Repayment options for agricultural loans and mortgages can vary depending on the lender and your financial situation. Some common repayment options include interest-only, capital and interest, repayment, and repayment holidays during difficult financial periods. Ensure that you discuss your options with potential lenders or a financial advisor to find the most suitable repayment structure for your circumstances. For more information on repayment options, consult with our broker. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.